Good morning, everyone. Thank you for joining us today at our Q3 2018 quarterly update webinar. My name is Amy Benstead and I'll be moderating the session this morning. Before we get going, I need to run through some housekeeping notes. Firstly, if you have any questions, please feel free to enter them into the chat box on the bottom right-hand side of the webinar screen. We'll do our best to answer all of these questions at the end of the webinar, but if we are not able to, someone from our team will reach out to you personally afterwards. Also, at the end of the session today, there will be a short 5-question survey. This is one of our first webinars, so please do take a moment to fill this out so we can build and improve on these going forwards. Okay, so now that housekeeping is out of the way, I'd like to introduce you to my fellow panelists. By way of introduction, I am Head of Data Products here at Preqin. I've been in the company for 12 years and am one of the hedge fund specialists here, so I'll be walking through the hedge fund results today. Alongside me, I have my colleague, Chris Elvin, who is another Preqin old-timer like me and has looked after our private equity products. So he'll be discussing our private equity and venture capital results. And last but not least, we also have, well, according to these pictures, our least smiley member of the team, Tom Carr. He's head of our real estate and private debt products. So hello, Chris and Tom.
Morning.
Morning all.
Moving on to what we'll be discussing this morning, we'll be digesting some of the key findings and trends taken from our Q3 2018 quarterly update report. All of these can be found on our Insights portal. For those of you that aren't aware, this is our new and improved research centre, which hosts all of our reports, blogs, and much more. So please do go take a look at our new Insights portal to get the full quarterly update reports across all of the asset classes. This morning, we'll be taking a look through the fundraising results of Q3 2018, as well as giving a small overview of performance, dry powder, and deals. And then finally, we'll be taking a forward look into the rest of 2018 and into 2019 based on the results of our investor appetite and data, as well as taking a look at those funds which are currently on the road. So to get things kicked off, I'm going to start on the hedge fund results and take a look at the hedge fund asset flows and AUM data. After this, we'll be moving on to the private capital results, which I'm sure Chris and Tom will be able to delve into in more detail. This is a first look at our Q3 asset flow hedge fund report, which has been released in a couple of weeks' time. So please do keep an eye out for that if that data is something that you are interested in. The chart on the left-hand side shows the quarterly asset flows since the beginning of 2015. And as you can see, that the latest quarterly data shows that there have been net outflows over the course of Q3 2018 of around $5 billion US. Looking forwards over the course of the rest of the year, we do tend to see quite a few redemptions being made at the end in the final quarter of the year, with flows tending to be relatively neutral or negative. So we are expecting there to be kind of more outflows over the course of the rest of the year. Despite that, we did see a significant level of inflows at the start of the year, so we are currently still in positive territories for 2018, but not quite the heights that we saw over the course of 2017. Obviously, hedge funds represents a variety of strategies and asset classes. And if you delve a bit deeper into the data, you can see some clear differences between strategies and regions. Firstly, on the strategy side of things, we saw the largest inflows into multi-strategy, event-driven, and CTA funds over the course of Q3 2018. On the flip side of that, macro strategies and relative value strategies saw the largest outflows over the last quarter and indeed over year to date. The final thing I'd like to draw your attention to on this slide is the regional results. I've highlighted the European results here. It's been a bit of a trend reversal from what we saw in 2017. In 2017, we saw Europe taking the bulk of the inflows last year, with North America in particular, obviously US funds, being rather neutral in terms of asset flows. 2018 has been a different story. We have seen investors rebalance in favour of North American funds, and they've seen all of the positive inflows this year amounting to around $40 billion US. European funds, on the flip side, have seen outflows of around $12 billion. So money has been shifting out of European funds and moving into North America and particularly US funds over the course of the year to date. Moving on to that and seeing what's driving some of these outflows and the wider trends within the hedge fund sector, I'd like to talk a bit about the performance that we've seen over the course of 2018 and in Q3 2018. All the usual caveats apply when you're looking at hedge fund performance. Obviously, hedge funds there's not a single asset class. It's a whole range of strategies investing in lots of different instruments in different regions. So the average across all the strategies does sometimes miss some of the nuances that we see between these different strategies and products. And the S&P 500 isn't the benchmark for most hedge funds. We acknowledge that and we know that, but for many investors, this has been something they've been comparing hedge funds to over recent years. And obviously, over the summer, there was strong growth particularly in US equity markets off the back of the robust economic and earnings data coming out of the US. Hedge funds, unfortunately, were not able to build on the tailwinds of that strong growth in the equity markets, and we saw performance of about 0.6% over the 3 months of Q3 2018, significantly underperforming S&P 500, which is up about 7.2%. And if you look at the longer time frames, we see hedge funds continue to trail S&P over both 12 months to 3 and 5 year annualized periods. Looking over the course of the rest of the year, the October results actually came in today. So if you are a subscriber to Preqin, do please come and have a look at our benchmark data. The new October benchmark figures have been released. For those hedge funds of you out there or investors in hedge funds, unfortunately, it wasn't a great month for hedge funds. The spike in US bond yields and the continued kind of volatility caused by the US trade war with China really did spook markets in October. And what we did see hedge funds suffer as a result. 70% of the hedge funds we track were in the red for October, and they are showing a loss as a whole of minus 2.35% for October, taking the year-to-date result down to negative territory, down about 1%. And if you look at that on a strategy basis, only macro strategies were in the black for October. So going forwards, I think we are seeing the end of the year being really pivotal for hedge funds. There's a lot of ongoing political events which really will be impacting markets and hedge funds' ability to produce returns. Obviously, based here in the UK, the Brexit negotiations will be key, and we will obviously see lots of volatility resulting from that. We have the US midterms coming up and other elections, all likely to hit markets and all likely to have a big impact on hedge funds. So please do keep an eye on hedge fund data over the rest of the year to see how these products are faring. And finally, linking these two factors together, this chart shows the hedge funds assets under management from the start of 2015 through to where we are now. Over the course of last year, we saw pretty strong growth in terms of AUM as a result of a perfect 12 for 12 in terms of performance, as well as strong inflows from investors. 2018 has been a different story. As we saw, performance has been pretty neutral, pretty underwhelming, and we have seen slower levels of inflows and net outflows over the last couple of quarters. The result of all of that is that AUM is basically plateauing. We've seen it plateau over the course of the year to around about 3.6 trillion, but still growing, but at a much lower rate than we have seen in the past. So, enough of hedge funds. Moving on to the private capital fundraising side of things. I'll pass you over to Chris and Tom to discuss how that has gone over Q3. Chris, perhaps I can start with you to walk through how Q3 2018 went in terms of fundraising.
Sure. Thank you, Amy. So looking with this first slide, which is quarterly global private capital fundraising from 2013 through to Q3 2018, I think it's important to kind of take a step back and look at the growth of private capital as a whole, and to understand what has been the main driver in the growth of private capital. We really are in a period of unprecedentedly strong fundraising, In fact, we've seen 3 consecutive years in which more than $700 billion has been raised by private capital funds globally. And 2017 was the pinnacle of that fundraising period with $862 billion raised. And again, looking at quarterly figures in 2017, more than $200 billion was raised in every single quarter, which again just goes to underline what a strong period it's been. Now, don't get me wrong, quarterly activity does not make a year or necessarily be indicative of a trend immediately, but the first half of the year in 2018, you can see that the quarterly figures around 172 billion raised in Q1, 191 billion in Q2, still very respectable figures, and slightly unusually, we normally see Q3 figures actually below Q2 levels, but for the first time in about 5 years, we actually saw an uptick with Q3 eclipsing Q2 levels, and $214 billion was raised by 327 vehicles. So getting back to the levels that we saw during the pinnacle last year. I think one of the other things that's quite interesting to look at when analysing this data is in the slightly darker bar charts is the number of funds, and you can see a sharp decrease in the number of vehicles reaching a final close, which is indicative of the capital consolidation that we're seeing across private capital as a whole, and particularly in areas such as private equity, which we'll get onto in more detail later. In fact, looking at some of the figures from the quarter, or rather for the whole of 2018 year to date, funds of $1 billion or more have actually secured 63% of all the capital raised so far year to date, making it kind of illustrative of how the sort of gap between the haves and have-nots is widening to a certain extent. This next chart is basically takes a look at the annual capital call-ups and distributions to LPs and the resulting net cash flows on a year-by-year basis. And I always joke that I think this is one of Preqin's most interesting charts on the private capital side, because it really does kind of give an illustration of what has been driving the strong fundraising that we've been seeing. If you take a closer look, back in 2013, something remarkable happened whereby the annual net distributions to LPs exceeded capital calls for the first time. Prior to that, that's not to say there wasn't strong performance, but it was a indication or illustrative of the fact that fund managers were delivering good nominal IRR returns to investors, but calling up ever larger volumes of capital. That trend, as I mentioned, flipped with resulting net cash flows to LPs in 2013 becoming positive. And as you can see through 2014, 15 and 16, we basically ended up in a period where the extent to which those distributions exceeded capital calls reached an all-time high again in 2016. So in each of those years, about $200 billion positive net cash flow to investors. And when you think about that in the larger context of investors who are largely satisfied with the returns that they're seeing, and having to maintain their allocations as their AUM grows, they've had to put a lot of that capital back into the asset classes in order to maintain those allocations. And it is what has in turn led to the very stellar fundraising that we've seen. 2017 figures, you'll see that trend still continues. However, interestingly, there's been quite a significant reduction, nearly halving to $114 billion, the latest data through to the end of 2017, showing that. So there are perhaps signs that by no means is it still not an attractive fundraising market, but there's perhaps some indication that the pinnacle that we've seen over the last few years is perhaps coming towards an end, and that fundraising levels are returning to, for want of a better word, more normal levels. And jumping into some of the asset class figures, so this is Q1 in blue, Q2 in orange, and Q3 capital raised figures by asset class so far in 2018. Unsurprisingly, private equity obviously accounts for the majority of the private capital universe, and reflective of the trends I've already mentioned, with H1 figures below that of what we saw in 2017. But in fact, Q3 again bucked that trend, and we actually saw $121 billion raised by 214 vehicles. So a bit of an uptick in that activity. Of particular note was North America activity. Back in Q2, North America focused funds secured about $42 billion. That figure nearly doubled to $82 billion in Q3, so a particularly standout quarter for North America. And again, just talking about capital consolidation, I think quite interesting to look at the 214 vehicles that I mentioned reaching a final close. That was 141 vehicles fewer on the private equity side than in Q3 2017. So really goes to show that despite similar, if not more, capital getting raised in the quarter, it's being done so by a fewer number of funds.
Okay, so things are looking pretty rosy in the private equity world. Perhaps, Tom, you can walk through some of the trends that you're seeing in the other asset classes that Preqin tracks.
Sure, no problem. So perhaps if I start by looking at the real assets side. I think what's interesting here is to consider it on a year-to-date basis, but also sort of on a quarter-by-quarter basis. And so what we've seen in natural resources and infrastructure, very, very strong fundraising in Q3. $7 billion plus funds closed in the infrastructure space in Q3. Real estate is a sort of slightly different story. Actually, it's the fourth consecutive quarter of a sort of slight slowdown in fundraising. Put in context, that is some sort of very high fundraising back in 2017. And private debt is holding steady. A strong Q3, coming off what was a sort of a bumper Q2, driven by a couple of sort of very large distressed funds reaching final closes there. So moving on, I mean, what's interesting is to look at sort of how those trends change over time. So the chart on the left here is looking at real assets funds and the amount of capital raised in the first three quarters of each year, so 2013 to 2018. So putting it a bit more in context, that sort of shows that actually real assets is looking sort of really strong currently, looking like we may sort of see another record year of fundraising, which I believe 2017 was very sort of close to. It also shows that while real estate's had a bit of a slowdown in fundraising, and some of the trends look like we're seeing somewhat of a slowdown, it's still having a very strong and very sort of bumper year. Infrastructure is particularly interesting here. You're seeing year-on-year growth and sort of quite substantial growth across that space. Sort of more and more people are looking to put sort of capital into that space.
Okay, Chris, perhaps we may have already stolen a bit of the thunder with the title of this slide, but how is 2018 shaping up for private equity? Are we seeing that real assets could be on track for a record-breaking year? What we've seen on the private equity side?
Slightly less glamorous for PE by comparison. Our peak was last year's story. No, I mean the reality, and as I kind of touched on when talking about slowing in inverted commas, it's still an incredibly attractive fundraising market. It is looking unlikely that 2018 will surpass the level seen in 2017. But as this chart shows, we've seen 308 billion secured over the first three quarters, and by comparison, even still very good fundraising years like 2016, 2015, it's on par, if not above, some of those prior years. And the you know, as I kind of touched on already, investors remain liquid as a result of these positive net distributions. I think there is a bit of a slowing and perhaps some other indications in terms of the fundraising momentum statistics and so on that we have, that is coming down a little bit from the pace of last year, but investors nonetheless remain committed to private equity, and I'm confident 2018 will still be a very good year for private equity.
Okay, so we've talked about things looking good in private equity and real assets. Let's not talk anymore about hedge funds. Tom, you're also one of our private debt specialists here, and it's been one of our big growth stories of the past few years. What are we seeing in the private debt world at the moment?
Sure. It seems I'm getting a lot of the positives here. So private debt is again looking sort of very, very attractive. And again, looking at it, the first 3 quarters of the year in comparison to previous years, the record for the first 3 quarters of the year. So it's likely we may well see yet another record year for private debt. We pretty much see year-on-year growth in that space, and every year is pretty much a record. There are a few sort of caveats to that. Q4 2017 was particularly strong, so we'll have to sort of see how that sort of catches up as well. Yeah, and to dig a little bit further into the private debt space, we've seen growth sort of year on year and coming out of the financial crisis and all the sort of macro trends that sort of drove the growth of private debt. And particularly when we're talking about the growth of private debt, in a lot of cases, we're talking about the growth in the direct lending space. That's where we sort of really seen the explosion. Strategies like distressed mezzanine have been around for a long time and sort of raising a lot of capital and continue to do very well. But the real sort of growth story within private debt is in the direct lending space. And that's evidenced in the chart on the left, where you see direct lending a little bit up and down, but gradually raising more and more capital. What has been interesting is that story initially was very much US-centric and US-focused. A lot of capital was going into the US, where the legal and regulatory regime was sort of very much set up for the private debt markets. And it's become very sort of established and mainstream there. However, what that's led to is very large amounts of dry powder. There's a lot of talk about competition, how that's affecting yields. Is that sort of driving down yields? What does that mean for the returns investors are going to see? And some sort of concerns rising amongst that. However, there are a lot of investors still looking to put capital to work in the space. So there seems to be a bit of a sort of regional diversification. So investors are thinking, okay, so North America is pretty saturated. Where else can I maybe go and put some capital to work? And what we've seen over the recent years is in the direct lending space, a lot of capital started flowing into Europe, where people sort of understand the markets. There's a sort of central regulatory regime and a lot of understanding of that. So we see more and more capital sort of flow into the Europe space as well. I mean, Ares, I think it's just closed a very large in Q3, a $6.5 billion euro European direct lending fund. So we're seeing some US managers come over here as well. So very much expecting to see the growth in that space continue.
Okay, so taking a bit of a different tack, we're seeing fundraising looking very positive across all the private capital asset classes that we track. Are there any key trends that we're seeing in terms of where that dry powder and that capital is actually being deployed in terms of deals? Chris, perhaps you can start with the PE side of things.
Sure. So venture capital is, looking at private equity as a whole, and despite concerns over high entry prices for assets, venture capital's success story seems to continue rising from a deals perspective. Q3 levels, slightly down on Q2 levels, which were record figures, but still close to 4,000 venture capital financings completed globally. And again, a slight drop in value, but still the second highest quarterly figure on record with nearly $70 billion in capital put to work. I think, VC in itself, we've seen a lot of large VC deals happening. Q3 illustrated of that in that there were 8 deals in excess of $1 billion, and the 5 largest were all in Asia. And I think that leads to the other trend that's been very common and becoming stable within VC activity is the growth of Asia, and in particular China. Looking at the breakdown via regions of actual deal activity, the US still accounting in terms of number for historically what used to be about 60%, but that figure is now down to 50% or lower. But it's the growth of Greater China, which in terms of volume of deals is nearly on par with the US very regularly, and that growth from the end of 2017 through to Q3 2018 continues. Moving on to the buyout deal space, and again, dry powder levels now at $1.14 trillion. I always take that with a little bit of context of the asset class has grown hugely. There are more fund managers, there are more funds. It's unsurprising in many ways that dry powder continues to increase. But perhaps what is of greater significance is one of the bits of analysis we look at quite regularly is the ratio of dry powder to capital called in the prior year to see whether fund managers are actually putting more money to work. And there are some indications of that when we look at buyout activity. If you look at this particular chart, historically for the last few years, the actual volume of buyout deals done each quarter has been fairly static, or around about 1,000 to 1,100. But since the end of 2017, Q4 2017, we've seen 4 consecutive quarters in which those figures are now closer to 1,200, nearly 1,300 in some quarters. So there are perhaps signs that fund managers are having to put more capital to work. And yes, high entry prices for assets remain a concern, and we wait to see what the longer term impact on performance might be. But the reality is for these fund managers is that they have to put more capital, invest capital throughout the investment cycle, and there are perhaps some signs that that is happening. Although, don't get me wrong, bull market conditions and so on to support the theory that it's still very much a seller rather than buyer's market. But it will be exciting to see how that plays out, particularly if an economic correction or perhaps entry prices do drop with so much dry powder available to fund managers.
Tom, looking to the real asset side of things, are there any key trends that you're seeing in terms of deal activity?
Sure. I mean, a lot of what Chris has said on the private equity and venture capital sort of side holds true in the real asset space as well. So a lot of it sort of the macro trends and sort of things about dry powder sort of increasing and high entry prices and what that means and sort of competition for assets and all that sort of side of things is very prevalent, I think, across alternatives. So relevant here as well. I think what we've seen in the infrastructure space was up until the end of last year, we were kind of on the whole seeing deal activity go up in terms of number of deals and also in terms of amount of capital put to work on the whole. 2018 has been a slightly different trend. We've sort of seen the number of deals has sort of fallen a bit or stayed fairly steady, which is interesting in light of how much dry powder there is. So it seems there's some sort of struggles actually putting this capital to work. But despite sort of a potentially a bit of a drop off in the amount of deals done, the actual sort of estimated and reported deal values that we sort of track here at Preqin have both remained pretty steady. So a lot of capital still going into the space. Slightly less deals being done, which I think talks to Chris's point about sort of high entry prices. The assets are more expensive than they have been previously. I know Chris broke down the private equity side and looked at it regionally. For the real asset side, I've decided to break it down and have a bit of a look at sort of the type of infrastructure deals that we've seen being done. And increasingly, we're seeing more and more deals done in the renewables space. So this is growing sort of year on year. The proportion of infrastructure deals that seem to be around renewable energy is roughly increasing. They are typically, in terms of deal size, slightly smaller than some of the other deals around sort of energy or transport and the like. But actually, in terms of the number of deals, very important. About 60%, I think, of all deals done in 2018 is looking at renewable energy. And what I've done on the side is I've broken that down by sort of type of assets. And you'll see that sort of solar and wind. We've really seen an increase in sort of solar being deals and such over recent years. And that talks a lot to sort of macro trends and sort of Paris climate change agreement and such, and sort of obligations that come from that. So the drivers for renewable in that sense are very strong. And then at the same time, some of the technology and pricing around it is becoming increasingly attractive. There's some stats around how much the price of solar has decreased as the technology improves, and it used to be assets that were reliant on sort of subsidies and such to make them work from a private capital kind of standpoint. In certain jurisdictions and such, they're now stand on their own 2 feet, and you're not relying on subsidies and the political risk that sort of comes along with that. So we very much expect to see sort of renewables continue to be an area of interest.
Okay, thank you both for that. We've looked at where we are now and what we're seeing over the past quarter and in fact over 2018 year to date. What we will do now is take a bit more of a forward look at where we see alternative assets moving through the rest of 2018 and then also into 2019, by taking a more of an in-depth look at our investor appetite data, so which asset classes are investors searching for today for the next year, as well as taking a look at which funds are open to investment currently. So starting off with investor appetite, this chart here shows the number of mandates issued on an asset class basis over the course of Q3 2018. Let's ignore hedge funds for the time being. I will come back to that, I promise. And what this is showing is across all of the private capital asset classes that we track, there is strong appetite. If you look at this as a proportion of the total number of investors in each sector, it's a strong number coming out across all of the various private capital asset classes, with private equity and real estate in particular being the most highly sought by LPs. So Tom, perhaps you can help us dig into that a bit further and give us more of an outlook and RE on real estate. I mean, earlier you mentioned that fundraising has tailed off a bit in 2018. Now, are we seeing any signs of this picking up at all?
Yeah, I mean, looking forward for real estate, it's looking relatively positive. So as Amy just touched on in that last slide, a lot of investors are looking to put capital to work in the real estate space. So I think you have to take the number of sort of mandates in sort of context of the size of the asset classes. So real estate is something that investors are looking for. I think the chart on the left here shows sort of the amount of capital investors are looking to put to work in the space. So comparing to last year, about half of investors were looking to allocate less than 50 million. So a lot of investors are sort of moving up and looking to allocate large amounts of capital. So it's obviously not just about number of mandates, it's also size of mandates. So looking at Q3, only 20% of the mandates we saw were for less than 50 million. So sort of indicating investors are putting more capital to work. So to dig a little bit further into that, it's worth looking at the number of funds and the number of sort of commitments they're looking to make. I found this particularly sort of interesting when you compare 2017 to 2018. So there's a bit of a sort of split. So in 2017, a lot of investors were looking to allocate sort of 2 to 3 funds, and now it seems to have completely split the other way. Some investors are looking to consolidate around one manager. Around 41% sort of looking to allocate to one manager and sort of potentially look after sort of number of relationships they have and sort of look at it that way. Whereas a larger number of investors, also 37%, are looking to allocate to sort of 4 to 9 funds. So they're looking at it more from a diversification perspective, and I want to be allocated to a wide sort of selection of managers and sort of the benefits that can bring. Oh, sorry, me again. So within the real estate space, what we have seen is we talked about investors looking to allocate more capital, and we're seeing increased interest sort of across the spectrum of real estate strategies. They're looking to put more capital to work, looking to invest in lots of different funds. So typically a lot of real estate investments been around sort of value-added and opportunistic space, which continue to be strong, but the sort of interest is increasing across the spectrum. The areas I sort of drew out of it, I thought the debt side was interesting. I thought the distress side was interesting in terms of the growth of distress, potentially sort of counter-cyclical, so not necessarily following traditional markets, and debt being an interesting area that, with sort of concerns around where we are in the market, there's potentially sort of more protected up the top of a capital structure. So I thought the sort of growth in those two areas were of a particular note.
Sounds like there's plenty of opportunities in the real estate space at the moment. Lots of money coming in, lots of investors putting cash in, and opportunities for managers big and small across all the strategies. So that's good news. And I want to come back to a slide I showed earlier, which is looking at fundraising on a quarterly basis year to date across various years. Chris, so we mentioned earlier that it's unlikely to hit the high heights of 2017 in terms of fundraising, but we did see that there's a significant number of mandates out there for private equity at the moment. Perhaps you can run through how you are seeing the rest of 2018 shaping up and what 2019 will look like based on investor appetite.
Absolutely. So I think just to take a step back, it's always startling to look at investor activity in alternatives and how far that has grown. Pre-Quid today is tracking around 11,000 institutional investors actively investing in alternatives, and that's an increase since 2003, 15 years ago, when we were tracking about 3,500. So far from being an alternative today, it's very much a staple part of investors' investment portfolios. And coming back to the private equity side, it's interesting to see the growth in that area. And in fact, it's just under 60% of investors now have an exposure to private equity, second only to the less glamorous real estate, I would argue. Yeah, it's indicative of how commonplace it has become. And I think what's also very interesting, not in this slide here, but something we regularly ask LPs is their satisfaction with returns, whether they've met their expectations, whether they've exceeded them, and what they're looking to do in the longer term. So looking back at this chart again about the number of mandates, it's unsurprising to me to see record levels, 377 mandates or searches issued, given the fact that I believe it's around 95% of the investors we surveyed are either satisfied or their expectations have been exceeded in terms of return. And over the longer term, it's actually the highest of any asset class in terms of the percentage of LPs looking to increase their allocation over the longer term, just under 80% of LPs giving that indication. So the reality is for many investors that the private equity model is working for them and is delivering the superior returns compared to public markets, as well as offering diversification and ultimately high absolute returns. So yes, I think it's relevant to see that and unsurprising given the appetite for the asset class. I think one thing to kind of come back to the point I made earlier, and just to show another illustration of this, is looking at just the private equity net cash flows to LPs. So this is private equity rather than private capital as a whole that we looked at earlier. Again, that trend of positive net cash flows slowing in 2017, in 2014, 15 and 16, about 150 billion positive net cash flows to LPs, significant drop in 2017. And if we go back to the last slide once more, the graph on the right giving an indication of the amount of money that LPs are looking to put to work. It's still an incredibly attractive fundraising market, but we're starting to see signs that investors aren't having to invest at the pace that they've had to for the last 4 years, in line with those distributions slowing slightly.
Okay, well, moving back to hedge funds and back to me. Going back to the slide I showed earlier in terms of the number of mandates issued over Q3 on an asset class basis, highlighting the hedge fund result, we can see that hedge funds are at the back of the pack in terms of the number of searches for a hedge fund issued over the last 3 months. To put this number in context, there are a similar number of investors in hedge funds as there are in real estate, and there's almost 2 times as many LPs searching for real estate than they are for hedge funds. So it does show that a lot of these concerns around investment in hedge fund, and a lot of the caution we are seeing investing is continuing. And again, showing some data which we've seen already on the private capital side of things. So it's a number of mandates issued on a quarterly basis. We can see there's been a general decline over the last 5 quarters, and this is the lowest number that we've seen since Q3 2017. And this is reflective of what we've seen in terms of asset flow data. As we've seen, asset flows have slowed down over the course of the year, and we are now seeing fewer investors looking for hedge funds. So, fundraising environment is continuing to look pretty challenging for hedge funds. A further illustration of that is the chart on the right-hand side, again showing the average size of the mandate. If you look at it from 2017 compared to 2018, we can see that the average size of the mandate is getting smaller. So not only are there fewer investors looking to put money into hedge funds, but they're actually looking to put less capital at work into the asset class. I'd like to put that in a bit of context, because I think people see this is the end of hedge funds. Everyone's taking their money out. It's very much not that. What we've seen in the hedge fund world over the last few years, the last decade in fact, is investors have significantly ramped up their allocations. If you look at the average allocations for a hedge fund to hedge funds for an investor compared to private equity, typically investing around 14% of their portfolio in hedge funds and 9% in private equity. So they really have ramped up their exposure over recent years. And what we are seeing is investors really consolidating around 14-15% as their ideal exposure to the asset class. And therefore, even though they're not actively looking to grow their exposure, they are maintaining that, and we are seeing turnover within their portfolios, but it's just not in the strong growth phase that we saw a few years ago. There are obviously many concerns around the hedge fund industry. I showed you the performance chart earlier on. We have seen some net outflows. Concerns around fees continue. But we are still seeing this consolidation within portfolios, and we are seeing investors do continue to look for new funds, but they are putting smaller amounts of capital to work. But as I mentioned, fundraising is challenging at the moment. I'm sure the hedge fund managers out there are seeing that themselves. And it's important to really get an idea of where you should be going when it comes to looking, for investors who may be interested in your fund. One of the big stories over the last few years, it started with CalPERS, I think 3 or 4 years ago, exiting hedge fund investment. It's been our institutional investors retreating from hedge fund investment. That is absolutely not the case. As I mentioned, we are seeing investors kind of reaching their kind of ideal levels of exposure to the asset class, investors like pension schemes, insurance companies. But there have been signs, particularly over the last year, that they're not as proactively looking for funds as other types of investors that we track. So across Q3 2018, 70% of the mandates that were issued were from either a fund of funds, a family office, or from a wealth manager. So if you are looking to raise capital, they may be an important source going over the rest of 2018 and into 2019. On a strategic basis, the chart on the right-hand side shows the mandates issued in Q2 2018 versus Q3 2018. So how that has changed. We've seen a big uptick in a number of investors searching for long-short equity funds, and in particular searching for CTAs. CTAs have been the one area of the hedge fund wider universe that actually enjoyed pretty good fundraising success over recent years. They've seen the largest asset flows over the last 2 or 3 years, and actually over the course of this year to date as well. And we are seeing continued strong appetite for CTAs moving over the rest of the year and into 2019. I think investors are growing increasingly concerned that we are at the top of the market, and they will need something which can help them on the downside, less correlated to equity markets, and money has been going into CTAs, and the expectation of that over recent years looks like that's set to continue. On the flip side, we've seen a drop in appetite for long-short credit funds as well. So, we are expecting to see more inflows into multi-strategy and CTAs, which reflects what we saw on the asset flow side of things earlier in this presentation. Moving on to hedge funds, less of a positive story to our kind of favoured child of the world, private debt, where everything's rosy. Tom, you mentioned that there's been an uptick in European activity over recent years. Is that continuing going forward?
Yeah, very much looks like that's the trend that we can sort of expect to see going forward. So we talked about sort of all the activity that's been sort of happening in Europe, particularly in the direct lending space. A lot of the distressed activity is still quite heavily sort of US focused, but obviously we saw direct lending, we saw Ares, we saw them raise $6.5 billion in Q3, and looking forward, it looks like that's a trend that's going to continue. Investor appetite for Europe is sort of only growing, so I think 60% of investors have said this is sort of an area they're targeting. That's greater than North America, so we should expect to see more and more sort of capital go into Europe, and we touched on some of the reasons sort of why that would be, and it's around the opportunity set. North America is quite a saturated market. There's potentially some regulatory changes there, maybe allowing banks to lend a bit more. Europe, on the other hand, looks very much like it might tighten that sort of regulation, if anything, potentially increasing the opportunity set. A lot of European private debt and direct lending activity to date has been focused on a couple of markets. So the UK is obviously being a very substantial one. I think a lot of people are seeing great opportunities sort of outside of those traditional markets. As it becomes more prevalent and as SMEs and the like become more aware of the sort of funding solution that can come from private debt and direct lending. So there are great opportunities more in sort of continental Europe. Germany is quite a key market, and even sort of more in sort of slightly more niche markets out in the Balkans and things. We're seeing sort of activities sort of pick up there and sort of interest and fundraising increase around those areas. Obviously, Europe does have its challenges around Brexit and the like, so we'll have to sort of see how that does play out going forwards.
Who knew Brexit could be so challenging, eh? So, right. So clearly lots of appetite for private capital funds, but we have seen continued challenges in the hedge fund world, but investors are out there looking for funds in large numbers. So before we finish and go through a few key takeaways, I'd just like to very quickly talk about kind of the options that are out there for investors. So which funds are on the market today? So this chart shows the number of alternative asset funds which are open to investment since the start of 2015. Just shy of 19,000 alternative asset funds. This is across the whole gamut from private equity all the way through to hedge funds, currently on the road looking for investor capital. This is a record-breaking number of those funds. However, there's the devil's in the details, and if you actually dive a bit deeper into these numbers, looking specifically at hedge funds, you can see that there is a different story. So a lot of that growth, or all of that growth, in fact, is being driven by private capital funds. There's a record number of private capital funds on the road. In hedge funds, we've seen a very different story emerge. Over the last few years, we've seen the number of new funds come into the market generally decline. We've seen more and more funds shut or liquidate. So there are now at least 4-year lows in terms of the number of hedge funds on the road, just shy of 15,000. You know, I discussed the performance issues around the industry over recent years. That's certainly causing a lot of the worst performing funds to close, as well as, you know, the large outflows from some of these smaller funds, forcing those vehicles to close for business. It's not necessarily bad news. The industry did get very large very quickly at the turn of the decade, and the performance of the asset class has in general declined as there are some weaker performing funds out there. We are seeing the industry in a period of consolidation with a number of funds coming down, but in the expectation that it will emerge stronger as a result of shaking out some of these poorer performing funds. You know, and when we speak to investors, they're often finding it very challenging to find the right funds for them just because of the sheer number of vehicles out there. So a lot of the winners we're seeing emerging are the better performing funds and those that actually can prove their value to investors. So, you know, we are seeing the industry as a whole evolve to be stronger and maybe more streamlined than it was 5-10 years ago. So, final part from us to run through a few key takeaways. Perhaps, Chris, I can start with you to talk a bit about what people should be thinking about in the private equity world today.
Yeah, and I mean, a lot sort of summarised here of what we've covered already, looking at fundraising, the health of that, the capital concentration that's occurring. I think, as I mentioned before, the deal activity is really the key one for me. That seems to be in a bit of a state of flux at the moment, whether a few quarters of slightly higher activity will increase and whether we'll see exit activity, the sort of deal exit scale balance swing in favour of the deals will be interesting to keep an eye on. And I think as well, it's not just remaining within the confines of private equity, but some of the points that Tom has touched on already is looking at private equity and the larger private capital industry as a whole is this ongoing evolution, you know, not just in terms of private equity firms, particularly lower down the chain now looking to private debt as the growth of that asset class continues, but also the ongoing kind of sophistication of investors who are ultimately satisfied with private equity, but looking perhaps beyond the traditional commingled fund structure and increasing activity in separately managed accounts and co-investments, and even as we've seen with the likes of the larger Canadian pension plans and CalPERS, the direct investment activity as well. We all know that private equity isn't the most nimble of asset classes given its sort of 10-year investment horizon, but I think we are in a period of sort of unprecedented change, as much as private equity could deliver that, given its illiquidity and the impact of things like technology, both in terms of fund managers and their internal operations, but also particularly looking at the assets they're looking to acquire. We've recently done a piece looking at technology-focused deal activity, which unsurprisingly has grown exponentially, and even sectors like healthcare, which traditionally haven't sort of been revolutionized in some of the ways that other industries have by the sort of tech to consumer delivery, I think will be interesting to watch.
Yeah, Chris and I have both been at Preqin a long time, and the amount of change we've seen over the last decade has been immense, and that's the effect of technology changing alternatives at the moment has really ramped up in the last few years, and I think it will have a significant impact on the industry as a whole. We've released a Future of Alternatives report recently. Please do find that on our research centre if you are interested in finding out a bit more in terms of where we see technology, or how we see technology impacting the sector. Okay, well, I'll be negative Nelly and talk about hedge funds now, because everyone else has got nice rosy pictures to tell, and it's still a good story. Still seeing growth, but what we've seen over the course of Q3 2018 was negative asset flows, but small, around about 5 billion. But because of the strong asset flows at the start of the year, it's still in the black. So we're still seeing growth in the hedge funds positive for 2018 year to date. However, we do think that fundraising is going to remain pretty challenging, and we expect it to be sluggish, not just over the rest of the year, but also into 2018. I think the investor search data, particularly in comparison to other alternative assets, does indicate that a lot of investors are focusing other areas of their alternatives portfolios, particularly on the more illiquid side of things. On the performance side, again, not a great story. Performance was pretty neutral over Q3, and Q4 hasn't started the best. And as a result of that and the negative flows over the quarter, it's just been a small growth in AUM. So we are starting to see AUM begin to plateau over the quarter in terms of hedge funds. And then over to Tom to cover the real assets and private debt.
Yep, thank you very much. So the real assets and private debt sort of pictures potentially looking a bit more rosy than we're seeing in hedge funds there. To take real assets first, it very much looks like we're going to see sort of record-breaking years for fundraising in natural resources, and particularly in infrastructure. Infrastructure is looking sort of very positive. I think people are very attracted to the risk-return profile of that in the current market, and where people think there may be some sort of correction coming, although people have been predicting that for about 5 years now. Real estate is an interesting one. We have seen a bit of a sort of drop in fundraising over the past sort of few quarters, but that is from very high levels. It looks very much like investor appetite sort of remains strong, and that's for real estate, but also for natural resources, and especially assets like infrastructure as well. Moving on to have a quick look, sort of summary of private debts. It's looking like we're going to see yet another sort of year for record fundraising in the private debt space. Presuming we have a sort of a reasonably strong Q4, I think I mentioned Q4 last year was particularly strong, but it looks like we're going to see another sort of strong year there. A lot of that is coming from direct lending as a strategy, which sort of continues to attract lots and lots of attention. We haven't touched it too much today, but distressed and mezzanine are still sort of important areas and still sort of very strong in fundraising as well. One thing we have seen in private debt, however, is sort of Europe becoming increasingly prominent, especially sort of in the direct lending space. So I think the outlook for private debt is sort of particularly strong. The obviously caveat to that is if there is a sort of change in the market cycle or the credit cycle, what that means. I think a lot of the attractiveness of private debt is people considering sort of downside protection if we're going to go through sort of market correction. So a lot of that will come down to sort of how it delivers on that if that sort of event does happen.
So we have had a few questions come through, but in the interest of time, because I'm aware we're already at 50 minutes plus into this, I'm just going to pick out one, which is kind of where do we see alternatives going longer term? And I picked this one out because it actually ties very nicely into a plug for our Future of Alternatives report that I had teed up already. So thank you for asking that question. Over the recent months, we've spent a lot of time thinking about where alternative assets are going, not just near term, but longer term. Preqin's been around for 15 years. We've seen the alternative asset sector grow and evolve hugely over that time, but we want to know where the industry's going. So we took a 5-year leap into the future to look at where we see the alternative assets industry heading by 2023. This chart here is actually one of our key charts from the report. It's out today. Please do go visit our research centre, our insights portal to find that report. The chart here shows our predictions for AUM by the end of 2023. And what we're seeing is it growing from around 8 trillion as of the end of 2017 to 14 trillion by the end of 2023. And there's a few key trends we see within this, which actually ties into a lot of the conversations that Chris, Tom, and I have been having today. And I think a key part of that is the growth trajectory of private equity versus hedge funds. To date, hedge funds are the largest asset class within the alternative asset world. But what we are seeing, or what we are predicting, is for the pace of private equity growth to outpace that of hedge funds, and for private equity to become the largest asset class today. I think a lot of the investor appetite information that we've seen in the presentation this morning supports that, as well as the fundraising we've seen over recent times. The second part I'd like to highlight, and actually Tom would like to highlight this on his behalf, is the growth of private debt versus real estate. We've seen huge growth in private debt since the turn of this decade. And the expectation is from all the managers, investors, service providers, as well as from our data, is that this growth will continue. We're expecting it to double in size over the next 5 years as banks continue to retreat in terms of lending and private funds stepping in to fill that gap. So we are expecting private debt to actually become a larger sector of the alternative asset world than real estate within the next 5 years. The report covers all of these AUM projections, but it's all backed by our interviews with managers, investors, service providers, as well as key contributions from senior members of the alternative asset world. Please do come have a look at it. It's got lots of good information in there, and for all of those of you looking to try to be part of this growth story of the next 5 years, it'll give you lots of tips on how to be a part of this big expansion of alternative asset data. So without further ado, I think I'd just like to thank Chris and Tom for joining me this morning. Thanks, guys. And for all of you, there's a big silence there. And for all of you that stayed on the line, we do hope you enjoyed the presentation. This is the first one we've done out of our London office. And when this finishes, you will be given a short survey. Please, if you can take a couple of minutes to fill that out, that will really help us with future webinars that we produce to make sure it's tailored around your needs. But thank you. Bye-bye.
Thank you.